Hello, it's my great pleasure to welcome Rupert Chapman to the great debate about 2021. But can we start by having a very brief flashback to 2020, which kind of really knocked everybody for six and was totally unexpectable. Not only unexpected, it couldn't have been expected, could it really?
Yes, it's been quite a year, hasn't it, David? Hello. And naturally, I don't want to tell you what happened in 2020 because everybody knows what happens in 2020. So what were the main features of 2020 that really come to my mind? And particularly, I understand we're talking mainly about property and property interested people. And to me, the main feature of 2020 was the autumn, when we had this really, really buoyant property market with transaction numbers going almost through the roof, professionals not being able to cope with the demand upon them. And this was something that probably, if you had predicted COVID in March, you wouldn't have predicted in the autumn. Obviously, we can look back at some of the prompts, particularly the stimulus that the government has put and in order to support that. But that's, to me, one of the, when we look back from a property point of view, an economic point of view, I think that's one of the key features that we're going to see is we're going to remember the autumn of 2020 when property values, transactions, the number of stock coming to market just absolutely expanded and opened up. Good quality stock as well, for various different reasons. COVID and change of lifestyles being quite a significant one.
And one of the interesting things about the UK here is that a lot of our economy hinges on this kind of feel-good factor, which is tied into property, isn't it? And people, when they see their properties increasing in value on paper, they feel more inclined to spend, and this provides stimulus for the economy and that kind of thing. So let's look a bit further forward, a bit ahead now at 2021, and stick with, for now, the property market. Which way do you see it headed?
Well, get the crystal ball out. First of all, nobody knows. Of course, nobody knows, because nobody knows what the future holds. And so people can talk with varying degrees of confidence of what's going to happen. I'm fairly confident, personally, that this stamp duty holiday will have a major influence on the property market in 21. A huge influence. And although some people are muting the idea that they might extend it, I can't for the life of me think of a reason why they would do that. I don't think it would increase any more stimulus. I think it would just give away a lot of tax revenues that they're likely to get because so many people are going to miss the deadline. So I personally think I'll stick to the 31st of March. And what we might see is the final flurries of the stimulus occurring in the early part of next year, with an increasing degree of panic on solicitors and professionals to actually complete. And I am aware even now that there are firms of solicitors who are refusing new work for fear of reprisal, because they themselves fear that they're not going to be able to complete in time. So that's going to be a really major influence on next year. 31st of March, we're going to see a final flurry of transactions. Well, we're going to see a lot of transactions because the deals have been agreed already, but the transactions haven't happened. So we're going to see a large amount of transactions and then a final flurry of new deals being agreed up to the 31st of March. But I think that as we get closer and closer and people realize that they're going to miss the deadline anyway, that's when I think that those that have put their house on the market to take advantage of this deadline are probably going to start to discount. And they'll probably discount from mid-February to the end of March in order to see their sale through. Once you've mentally decided to sell a house, you've moved on then and you want to go through with it. But then we've got the other side of the coin, haven't we? And I fear for that, I must say. The way I view it is that it's a bit like borrowing and repaying, that Rishi Sunak has borrowed next summer's property market and he dumped it into this autumn. That's the way I feel it, and therefore the payback will come next summer. I personally can't see when the end of this stamp duty holiday ends, I can't see that the market will be anywhere near as buoyant. I think it will contract quite considerably. Now, that doesn't necessarily translate to values. A contraction of stock, a contraction of supply doesn't necessarily translate to values. But what tends to happen is that you start to see values falling, you start to see offers being accepted, and there you start to see a lack of confidence of people putting their stock onto the market. So I expect to see that. And of course, when we do see that, then what we find is that the building industry then tend to get very, very busy making extensions and going up into lofts and doing things that people choose to do as opposed to selling their home. And I think I should add here that as property investors, we're very, very centric to investment properties. And but of course, if you think of property as a whole as a cake, then cut the thinnest slice you can possibly cut of a cake, and that's the investment market. So the great influence here is to do with the owner-occupier market and the chain sale market that will influence here. There could be additional stimuli put into the investor market, of course, at that point in time, and there's been a few things muted that may well happen in order to stimulate the investor market post-March. But in terms of values, it's such a thin slice of the overall market, I don't think it's going to have a significant effect on values. So we can see a lowering of values post-March and a massive contracting of stock post-March is my best guess at the moment. Doesn't mean good deals can't be done now, and it certainly doesn't mean good deals can't be done post-March. There will be a lot of good deals that can be done post-March, but the quality stock, remember, when a property market is buoyant, it's not just buoyant for the buyers, it's buoyant for everybody, and everybody comes to market. You know, everybody brings their pigs to the centre of town, and it's, you know, a great flurry of activity. And of course, when you have a contracting market, then the quality stock goes away, and you're left with lesser quality stock generally. So it could be good for investors.
Yes, and you see, normally, because, you know, property cycles is a sort of hobby horse of mine and so forth, and normally these cycles are quite slow and take a long time to come to have any sort of effect. And one of the things that happens, particularly when the market is correcting, when prices are going down, is there tends to be a lag between what's actually happened in the market and what prices are attainable for a particular property and vendor expectations. And this lag can be anything from 12 to 18 months. But I think at the moment, every single person on planet Earth is aware that we're living in extraordinary times. So again, in the same way that, you know, the GDP took the biggest hit of all time, I think we're not necessarily. I think many of these timescales will be compressed. And so that if there are contractions in the property market, I think the penny will drop for everybody very quickly.
Yes, I think it'll be a very significant and very noticeable change that we'll see next summer. And of course, we are not discounting the effect of COVID as well, because, you know, we're not taking it as read that we're back to normal by next summer. And so if there are further lockdowns, further restriction in general trading activity carrying on through next summer, which could well happen, then of course that's going to have a negative effect on transactions as well.
Yes. Now, another thing that influences the whole economy, but also property in particular, is interest rates, which are now sitting pretty damn low. Could they go much lower, do you think?
Well, it's always possible. I don't think it's desirable of the government, and I don't think it will have a beneficial effect on property investors, because I think the mortgage rates have pretty much come as low as they can come. You know, at the end of the day, a margin has to be made, and if there's a negative interest rate, then okay, they might be able to come down a point or two, but we ain't gonna see banks paying us to own property. That's for sure.
Or might it cause a lot of capital to suddenly come into the market and be used to buy property?
Well, I would say less interest rates, and I think the main capital that comes into the market for property comes in as capital rather than as debt, and therefore I think that there are other probably more significant factors with regard to other commodities that could be influencing money coming into property. I also less amount. People are less driven by opportunity when it comes to investment. They're more driven by fear. People are more than happy to take a small amount of growth for a well-protected investment, okay, than go out and take a high-risk investment for a large amount of growth. So it's fear that drives. So if the money is being driven into property, it's because fear is driving it from somewhere else, not because opportunity is pulling it in, I would say.
Yes, and another area where people might be fearful is possible tariffs, which might be in effect in 2021 that are not in effect now.
Tariffs is a really interesting subject, and it's not being talked about at all, I would say, hardly at all. It's great that you've raised it. Maybe you're the first one to raise this subject. But of course, we've been talking about all these tax rises that Rishi is going to need to do in order to recover from all of these handouts and everything else. But we haven't considered that if we are forced into a tariff-based economy next year, which personally I don't think we will be, but if that does happen, then of course that is going to fill the Treasury coffers quite considerably. And it could actually take over from the need to actually stick taxes up considerably. There'll probably be a combination of both. But I also feel, and just talking about taxes as opposed to tariffs, I also feel that perhaps this crisis will be viewed similar to the sort of economic effects of a war, where you ain't going to repay it in the next couple of years by doubling the taxation of people. You literally got to budget that over the next 20 or 30 years. And I suspect that will be the approach, because, of course, tax revenues are much greater when the individual tax rate is low, but the speed of movement of money is fast. If you slow down the movement of money in a recession or a depression and up your tax rate, all you're doing is actually putting the brakes on the movement of money. So it's self-defeating, really, to put the taxes up too great.
Yes, I agree, and so yes, the R word, recession, which is possibly looming. It certainly will be on a lot of people's minds in 2021. Will we see a recession at some point?
Well, what we're seeing, and perhaps it's not widely reported because of the delays between figures coming out and the press jumping on them and putting them out there, but what we're seeing on the ground is that there are a large-scale redundancies, particularly amongst younger people and working class people and the lower earners, and that it's happening already. There's a huge amount of layoffs going on at the moment. It's all very confused because of furlough is confusing the situation and all the rest of it. But yeah, I mean, let's put it this way: people on furlough are not working. So they are not contributing to GDP, whether they're being paid or otherwise. So we've never seen unemployment or unemployed activity to the level that we currently have, and it's massively higher than the unemployment figures would actually state. It's huge, titanic at the moment. But the question is that when things get back to normal and when we can start to tear off our masks and live as normal again, just how much of what has happened this year is going to have a hangover in terms of a recession. Again, recessions are very much about fear. They're very much about people's behavior, people being protectionist about their money, holding on tight, not spending it, for fear that things will get worse and they won't have the money in the future, or they won't have the job in the future. There is a theory with quite a lot of credibility that what we'll see is a situation that this is almost like, the Jubilee Day, the out in the parties, wave your flags, the war is over, we've fought the virus, we've been given all this money from the government. Savings rates in the summer of this year were 29% of household income, and our normal saving rates are about 4.5 to 5. So I can see that there's potentially going to be a fair bit of spending, which could result in business confidence, could result in people being re-employed. So who knows? It could be short-lived.
Yes.
We just don't know.
And I suppose one final point then is regarding 2020: risk, opportunity, or a little of both.
Well, risk of values. I mean, I've been sort of avoiding flips since 2016, and prior to that, but prior to the referendum, because I've been fearing future values. So future values have never been so uncertain, and it's just become more and more uncertain. And today the future values are as probably at the height of uncertainty, aren't they? So it's very difficult to know. I mean, I know that there's a lot of people still doing developments, they're still getting planning, planning relaxation is happening. And I've got a couple on my desk at the moment, some really, interesting, fantastic developments that people are going on and looking for funding on. But you've really, in terms of when you're looking at that and you're advising a funder, you've really got to see a lot of headroom in these figures. You've got to see, big GDV, big differences between cost of development and GDV. People can't be doing it for small margins, because you literally could be looking at, 20-25% value drop. I'm not saying it's going to happen, but you have to look at that within the figures. Just as a comparative there, sense check on that, the Lehman recession had a value drop of 18% across the whole country. And the difference within the country wasn't actually the value drop. It was 18% in the northeast, and it was 18% in London. What was different is that the value dropped by 18% within 18 months in London. It dropped by 18% within 4 years in the northeast. So the time it took to hit the bottom was much, much longer in the regions than it was in London. And of course, then we all know what happened is that London then came back and beyond. And the northeast still hasn't recovered back to where it was before. So so it's not outlandish to say that a worldwide crisis, which causes the whole economy to basically stop for the best part of 6 months, would result in a 25% value drop. I'm not saying it's going to happen, but it's not an extreme outlandish statement to say that it could happen.
And on that note, we'll leave you. And I take that as a note of general kind of optimism, broadly speaking. And on that basis, I'd like to wish you and everybody watching today all the very best for the coming year.
Thanks a lot, David. And of course, as a final point in this is that an entrepreneur's fodder is change. And we've never lived through change like it. And next year is going to... The story is going to keep going. There's going to be more twists. There's going to be more turns. We don't even know if we're going to be as locked down today in a year's time. We may be, So there's going to be huge amounts of change next year, and that means opportunity. But people have to be very, very shrewd when they're determining what an opportunity actually is, because some of these opportunities that might appear to be opportunities may actually not be in the end. But yes, thank you for that, David. Have a great Christmas, and no doubt we'll have lots more to talk about next year.
For sure. Thank you, Rupert.